I do a lot more of consolidation trading than I do breakouts, but maybe I can help provide some information on both. And some of you may be more inclined to trade breakouts, and some others may like the pullback style that I use, but I'll try to give you some information on both. So let me start off and just kind of walk you through a little bit of what I think about in terms of these breakouts. Okay, so first of all, a breakout. I don't want to take anything for granted here, but a breakout is when price action is moving above a prior high. It could be a high from back in January. It could be a high back in November. It could be a high from back in 2014. It's just a breakout is taking out a prior high. Now, others might look at breakouts as maybe and I guess I would include myself in this as well. It can be a breakout of a pattern. Doesn't necessarily have to be taking out a prior price high. So for instance, if we were looking at whiting, I didn't annotate this, but if you look at this downtrend, you got a little channel going for a while. Clearly this candle here, as you move back up, has broken out of this downtrend. The sideways action kind of broke out of it, but certainly that heavy volume move there, that I would consider to be a breakout of just a period of price declining. Same holds true over here in November, where we were declining, and then we sideways consolidate, and all of a sudden volume comes in, and we make a little bit of a breakout above that prior high and that downtrend. So you've got to keep in mind that there are multiple breakout types. And as far as trading them, I guess it would depend a little bit on how comfortable you are with each type of breakout. Some refer to breakout like this above the moving averages. I'm not as much in that camp. I think a lot of times when you're consolidating like we were here, you'll see these moves above and below. I don't want to call this a breakout, this a breakdown, this a breakout, this a breakdown, I mean, to me, it's just sideways consolidation. I don't really see breakouts, but there are many who do look at it. I find a move through the moving averages and price resistance to be doubly bullish. Anytime you can line up more than one indicator, I think that's a good thing. So with whiting, though, and all of these stocks that I'm going to be giving you on the breakout part of this workshop came from yesterday's 52-week highs. So you can see yesterday it was putting in a new high. That is, even though my charts only goes back 6 months, it is a 52-week high. So, you know, when you think of a stock hitting a 52-week high, I automatically think of a breakout. But if I looked at this chart yesterday and I saw it moving above the prior high, I would not necessarily be interested in buying it. And the reason being, I always want to manage how much risk I'm taking relative to how much reward I think I can get out of the stock. Now, in this particular case, after it had gone sideways here, it looks like maybe sideways consolidation, $3, it makes the breakout. If you had caught the breakout here at, say, I guess that would have been April 10th, the volume did pick up, it confirmed. If this was the breakout you were playing, you might be able to set a target and say, well, you know, it just consolidated in a $3 range. I'll be looking for a $3 move from 35. If it gets to 38, I'll take it. If it closes back below 35, I'll get out. That, to me, would set up a solid reward to risk trade. But yesterday, it's making a 52-week high. And when I look at the chart, I'm looking at a stock now that has an RSI at 74. You can see that the PPO is pretty stretched. Anytime you get a PPO up around 6 2/3%, that's telling you that it's been moving pretty solid. And you go back to February low of $22, and here we are up near 40. This stock's gone quite a ways, and just a normal pullback to the rising 20-day moving average, which we've seen multiple times during this uptrend, would present quite a bit of risk. Right now, the 20-day is sitting at $36, just below $36. We'd be looking at a 10% decline just to have a normal test of a rising 20-day moving average. So in order to justify this trade, I would want to see at least a 2-to-1 reward to risk ratio. So if I'm willing to take 10% of the downside, that means I better figure out a way to look for 20% upside move or more. And there's just no way, looking at this chart, that I can project that. So I would look at this and say, yeah, I really like this chart. It looks bullish. It's been behaving bullishly. It's in a nice space in the market now, but it's not at a level that I would buy, even though it is in breakout territory, because I want to get it on a pullback. And that brings up a whole different concept. You can play breakouts if you catch the breakout, but the second entry a lot of times is when it goes back and tests that breakout area. There's a lot that's been written at StockCharts, and a lot of the technicians refer to broken resistance becomes support. That's kind of technical analysis 101. So when you break above a key area of resistance, a lot of times you'll come back down and you'll test that support level and then move higher. The beauty of that is that when it comes back down and tests your support, now all of a sudden you can get into a trade with fairly limited risk because you're expecting it to come down, test, and then bounce. Even a test of the 20-day moving average at this point, if I got in at 36, I'd be looking for another move back up to 40, which would be $4. I could put a stop in of about $1 to the downside because this is my price support level. So now all of a sudden I've got a 4-to-1 reward to risk ratio. So when I look at breakouts, that's how I try to evaluate it. I have to be able to set it up so that I can hopefully collect more on the reward than I would be risking to the downside if the trade falls apart on me. And they will fall apart. There's nothing. I mean, it could just be the fact that the market gets weak. It could be the fact that a particular sector or industry group that you're in sees money rotate away from it. Your stock may be perfectly fine, but it may just simply lose support because there's money rotating out of the group. I expect it to hold support. Many times it will, but I've seen plenty of support levels fail to hold. And so as a result, I mean, this would be a perfect example here. You've got this area right in here at about $28, $28.50. You break above, you come back down, you test it, you bounce, you think you got a winner, and then it falls apart. So you have to be prepared to step away from this trade. Otherwise, this would have been this would have been very painful over about 2 weeks to get into a stock around 28 and 2 weeks later be down 21 and change and trying to decide whether to hold as it threatens a multi-month breakdown. That's where all the emotions come into a trade. So a lot of different scenarios here on whiting on this chart. And I just wanted to point some of those out, how, at least when I'm looking at a chart, how I try to set up a potential trade. I do have a couple of others that I have annotated. I don't have all my charts annotated, but I do have a couple others. Here's Grainger, WW Grainger. First of all, this has been a great performer. This is a company that has produced excellent quarterly earnings the last 2 quarters. We saw it back in January with the huge move up on heavy volume. Notice it comes back down and consolidates. It was very overbought, but at one point it dipped into the 40s on the RSI, printed a hammer on the 50-day moving average near support. So I guess my question would be, if you're trading a stock like this, do you want to do it after it's gone up 2 straight days with an RSI at 80, knowing that you could get a 20-day test and be very painful? Or would you rather a stock consolidate over 5-6 weeks, pull back, RSI drops into the 40s, we print a nice little hammer on the 50-day moving average near gap, well, in gap support, near a prior support level. Now you get into a stock like this at 250, and you're looking at the prior high near 300, and you're calculating, okay, that's a potential, really nice potential gain on Grainger. Whereas to the downside, maybe I give it this low, maybe I give it the prior price resistance, which is then support. I mean, even that's down around, 240-ish. So maybe I have $10 or $15 of room to the downside that I give it, but I've got $45 back to the upside. So again, you've got a much stronger reward to risk if you allow the stock to come back. Now, it's hard to get past your mind sometimes because, your mind definitely plays tricks with you. And when a stock is coming down, I took a course long time ago. It's probably about 12 or 13 years ago. It was one of the best courses I took, though, and it dealt with the psychology of trading and the fact that humans, it's their nature to want to be part of the crowd. Whatever everybody else is doing, we kind of want to do that. That seems right. So with trading, a lot of times you get stocks that are moving higher and you watch it go up 8-10 days in a row and you're like, wow, this is the kind of stock I want to be in. So you jump in. And then when it starts moving down 4 or 5 days in a row, you can't take the pain anymore and you get out. You're in a perfectly good stock, but you pick the wrong time to get in and you pick the wrong time to get out because the human emotion starts taking over. So you really have to pay attention to that and monitor your reward to risk when you're entering. And I always say, you got to know why you're getting in, what it's going to take to get you out. In other words, where your stop's going to be and what your target is. And you should evaluate that trade every day at a minimum. Now, I'm more of a daily or, short-term trader. So I'm going to hold stocks. I mean, if they don't work out for me, I could be out of the stock same day I get in, because a lot of times I'm getting in near support. And if a stock doesn't hold that support, I could get right back out and take a small loss. So those are some of the things that you need to be thinking about. But GWW here has got a beautiful uptrend. You can see the consolidation, these equal highs. It did break out here yesterday with a very solid earnings report. But look at that black candle. It tells me that even though it gapped up and there was a lot of demand at the open, it did get to 310 earlier in the session. It came back down and closed at 300. So there were sellers out there. Many times you'll see the gap fill, maybe a 20-day test, maybe another trend line test. I think as WW Granger drops here and gets down closer to about 284, 285, I think things start to turn very solidly in favor of being long this particular stock. The next stock up is AYX. Now, when I'm looking at stocks, I also want to be aware of what's going on with the PPO, because that's telling me whether or not I have momentum issues. And so I could look back here at AYX, for instance, back in November and December, and you see how we put in the higher highs, and check out the PPO. You got a much lower PPO reading. So many times you'll see an extended period of consolidation, sometimes outright selling, and that's exactly what we saw here. Big selling, went all the way back down, hit the 50-day moving average. The PPO worked its way back to centerline support, and then the stock became a pretty good trade. So you want to be careful if you're jumping in on a breakout if you have a negative divergence, because that's what we had here. So if you get a breakout above these prior highs and you fail to hold the breakout, to me, that's a big warning sign. Now, in this case, we worked our way all the way back to the center line, and we're starting to strengthen again with this move. But check this out. Now, if I bought this stock on the breakout yesterday, if I had bought it because I saw it was breaking to a 52-week high and it was taking out this prior high, I would get out if it failed to hold that on the close, because I would be thinking it's going to go all the way back down to the 20-day. And if it's going to go back down to the 20-day, I don't want to be holding it as it does that. To me, it's just tying up capital. Maybe some of you, it's too active trading and you're not interested, and that's fine if that doesn't fit your style. But for me, I do watch the market all the time, and I don't really enjoy getting into a stock that reverses and then watch it go down for the next 2 or 3 days. What I would rather do is get out, and if I still like the stock, when it goes down over the next 2 or 3 days, get back in when it hits the 20-day moving average and save that pain on the reversal. So this one is a breakout, but it was a false breakout, and these can be really painful if you're a breakout trader. You got to be able to recognize that that was not a good candle, and don't take the chance of it going lower. And I don't know if it's going to go down to that 20-day moving average or not, but I've seen enough charts to realize that there's a good chance that it's going back down there. So I don't want to hold. I wouldn't want to hold that. And I do think a lot of times the breakouts, there's so many different factors to consider. I think you can get a lot of whipsaw with breakouts. And again, I've traded breakouts a lot over the years, and I did not find it to be nearly as successful for me as trading consolidation. And I'll get into consolidation in just a minute. Let's take a look at a couple more of these charts, though. NSP, big breakout here. And actually, I should have moved this arrow over one more candle, because here's the sideways consolidation. I think one of the things that's most important to me on a breakout is I don't want to get a stock that's broken out and has been trading higher 6-7 straight days. To me, you're going to get an overbought situation where RSI moves into, up to 70 or above 70, and then you're just going to run into some difficulties if we start to pull back, because you're going to have so much room between current price and that rising 20-day moving average that it's going to become painful just on a normal pullback holding a stock. So I don't like to buy it. I don't like to chase a rally. Now, this candle right here, which was on April 13th, was actually breaking out, and there was some decent volume. Now, overall, I would like to see a little bit more volume on my stocks than this one has, but you definitely can see that the volume picked up on this move to the upside. I think that's bullish. I want to know that there's some accumulation taking place on a move to the upside. If it's very light volume, I'm going to be afraid it's manipulation. So here we made the breakout. Now, if I bought it on that close, I would be looking for sideways consolidation, roughly of about $5. I could look for a measurement of $5 up to about 77.5, which we have since reached. So literally a stock like this, I could have owned it 3 or 4 days and been out of it, got my $5 and moved to the sidelines because I hit my measurement. And you might say, well, why? Maybe it'll go up another $5. Well, the problem is I don't know exactly how much further. I don't have a measurement that takes me up any further. And what if it just pulls back to 72.50? Am I just going to give away that profit and wait and then see if it comes back up? To me, it did exactly what I wanted it to do. If I was getting in and I calculated a target of 77.50 and it hits it, why wouldn't I take it? So again, it's a timing thing. If I don't catch this move when it's first making the breakout, I would let it go and wait until I can get a better reward to risk entry. Because again, here, what I'm looking at is as it's making this breakout, look at the PPO. See how we had a negative divergence? So it's breaking out on heavy volume. So I'm okay trading that. But if it fails to hold the breakout, I'm going to get out. So I'm able to keep a tight stop. But I can't do that if I wait and buy it 4 or 5 days later. HES, HES, I think I just have a couple more here on the consolidation. But here's a beautiful breakout. PPO looks good. Volume's picking up. Again, if I get it on this breakout, I could hold it so long as it doesn't close back below that support level, which this one didn't, and it continued moving higher. One of the problems, though, is that as it made the breakout, you can see we are a little bit, or at least we're approaching overbought, and I really don't know where to set the target looking at this chart. Now, maybe if I went to a longer-term chart, I could find a resistance area, but if this happened to be an all-time high breakout, which I know it wasn't on HES, but if it was, the problem is where do I set a target? So sometimes if I don't know where to set a target, it's really difficult to trade because I don't know what it's going to take for me to take profit. So I'm going to start allowing emotions to creep into that trade. RIG, this is, oops, I thought I had one more that I had highlighted. Well, let's pull up RIG because I did have that as another breakout candidate. And here you can see, here's your breakout. PPO looks great. The breakout was clearing this prior high of 12.25. We went below intraday, but now we're starting to come back up. If I got into this breakout, number one, I would probably be hard pressed because the RSI, you can see just a couple of days ago when it broke out, was probably in the mid to upper 70s. So I typically don't jump in then. We've had a huge run. What happens if we just make a quick pullback to the 20-day? I'm going to be down 10% on my trade and still not hitting a stop area. I don't want to be down 10% before I'm ready to pull the trigger on the sell. I want to make 10% to the upside, but I'd like to keep my stop to maybe 2 or 3%. So this one would not have worked out for me, even though the chart looks great. It's one I certainly would keep on a watch list. And then the last one I wanted to mention here, INXN. I think that this is a pretty interesting opportunity because if you look, I'm going to pull up the weekly chart. I think what you got is a beautiful uptrend, and this cup that we just saw on the daily chart. Let me go back. See here, you think, well, that might not be a cup because it's kind of erasing most of this uptrend. That's why you want to go to look at a weekly chart. And on a weekly chart, you can see we had a very long uptrend. This is a nice little cup, sideways consolidation, putting in the handle, and now we're breaking out. And look at the volume picking up on this move. This actually measures up to about 73 to 74. So on this breakout, I have a measurement of 73, 74. To the downside, I've got price support and that rising 20-day moving average around 63. So even at the current price, I could maybe make a little bit of a case for it, although I'd really like to see a pullback back into 63s. Then my reward to risk gets even better, and I can keep that stop much tighter. So that's kind of the way I look at breakouts. There's, as I mentioned, there's a number of different ways to play breakouts, but these are some of the more common for me. I do want to make sure volume confirms on the moves to the upside to breakout. I want to make sure that there's accumulation. To me, it just gives me a little bit more comfort that market makers are likely building an inventory on the move to the upside, and that usually is a sign of accumulation. The other things to keep in mind, when you're breaking out, to these new highs, but you've got your RSI above 70, just a normal 20-day test, I mean, it looked great on the first day of February. 2 days later, that would have been painful, down $3 or $4. Again, I think you're just taking too much risk when you chase these moves to the upside. And then finally, if you miss the initial breakout, a lot of times you can catch that on the way back. You can hit price support. Now, consolidation for me, my preference is to trade where I can maximize my reward and minimize my risk. And I always try to establish my price target, my strategy. Am I going to buy at one level? Am I going to buy at a couple levels? And also I want to consider where I'm going to put a stop before I ever buy the stock. So I'm going to bring you up a couple of, and I want to go over a little bit of the trading results at earningsbeats.com, because really what I do, I mean, I help John Hopkins at Earnings Beats create their trading strategy using only companies that have beaten top and bottom lines. That gives me a little bit of fundamental comfort about the companies. And then when they come back to a key support level, it just gives me a little bit more of confidence in placing that trade. So I'm going to pull up a couple of these trades. And these are trades. I didn't go back into my own personal trades, although I think I did have one or two of these. But these were trades that Earnings Beats had out. And just to give you an idea or sense of how trading in consolidation can work and how they can benefit you. I know that I did a webinar with John Hopkins recently and went over the earningsbeats.com performance results. And just to give you an idea, back in the second quarter of 2017, Earnings Beats had 5 winners and 6 losers, only had 11 trades out. But the average gain was 6.49%. The average loss was 3%. So better than 2-to-1 ratio. In the third quarter, there were 10 winners and 6 losers, but the average per winner was 8.1%, and the average per loser was 1.64%. And then in the fourth quarter, they really stepped up their trading candidates, but there were 21 winners and 18 losers. And the average gain was 6.19%. The average loss was 2.28%. And I mention this because I think it's really important to admit sometimes that what you think is going to happen in a trade doesn't happen. And when I went back and added up those winners and losers in 2017 for those last 3 quarters, Earnings Beats had 36 winners and 30 losers. And the market had a really good year. And you might look at that and say, wow, 36 and 30, that's not very good. But the key is in the returns per winner and the returns per loser. Having your stops tight takes you out of big risk to the downside. And then having targets 2 or 3 or even 4 times higher, obviously is going to create a lot more potential return. Now, when that 2017 result came out in those 3 quarters, I think that the total that was used, because Earnings Beats never had out more than 7 trades at any one time, I think because John had asked me to calculate their risk-adjusted return, and I went back and did that for him. And so I used a $70,000 make-believe portfolio. And I used $70,000 because I assumed $10,000 per trade. And there were never more than 7 trades out at one time. So I knew that there would never be any margin interest or anything like that. But what I found is that if you had just invested that full $70,000 into the S&P 500, that over those 9 months, you would have made, actually made $8,855, which would have represented, I don't know, probably about a 12%, 12.5% return. Earnings Beats on those actual trades that were put out there showed a profit of $16,438, which was almost double what you would have had in the just investing in the spider. Now, the real trick here is only 40% of the account balance was invested throughout those 9 months. So you're taking 60% of the risk out and you're doubling your return. Now, I'm not saying you're going to get those kinds of returns, but that's the whole idea. And that was the concept that we, that was born at Earnings Beats back in 2013 when I worked with John. And so I think that this is a system that works It's worked through different types of markets. It worked through the 2015, 2016 corrections. It's worked in the moves to the upside. It's worked in downside moves. And the bottom line is, number one, when the volatility index is rising, you want to trade less because you're going to get whipsawed. You're going to take some rather quick hits. And sometimes if you don't use intraday stops, you're probably going to take some really large hits, as we saw over the past couple of months. But it's really important to me to make sure that you do keep those stops in play and that you analyze the environment that you're in. I would much rather trade a market with a VIX of 10 than a VIX of 30. Some people really like that excitement and of waking up to futures that are up or down 500 points. To me, that is like, I need Pepto-Bismol. I can't even sleep wondering what's going to happen the next morning if I leave a bunch of money in the market. So I tend to move more into cash, and I rarely trade in these high volatility environments. But I want to go over just a few of these stocks, and then we'll wrap up, that Earnings Beats put out, and just kind of go over, I don't want to say their strategy, because it's also my strategy. I use the strong earnings chart list, and a couple of these stocks I did own. DO was one. I did own this stock, and I'm going to go back a little further. This is a 1-year chart, and you can see that we had a nice move higher. Energy stocks were doing much better, and Diamond Offshore was having this nice move. Earnings Beats actually put this stock out on November 27th at $15.38. And I was looking at it on the chart. And of course, you had been moving higher. The PPO was weakening. So you're looking for a 50-day test. This stock came right down on the 27th, tested its 50-day, tested price support. And I'm not sure. I didn't go back in and look to see what the stop was. My guess is it was probably a close below the 50-day moving average. Target, I would have thought, was back up near 17.5. But I did see that the exit was on December 12th, right here, and the price was $16.97. So it was $1.59 winner. So a little bit more than 10% in 15 days, something like that. And then you're back on the sideline, and there's no more, you're not at risk. Now you might say, well, boy, you could have made a lot more money. Well, yeah, and if you were a perfect timer, that would have been awesome. But what if you continue to hold, and then all of a sudden you watch this entry point of 15.38 become 13 and change? And now instead of having a 10% winner or 20% winner, now you have a 10% loser. That's what happens in the market to most companies. Not every company like Netflix and Amazon and Apple go up years and years and years, just keep going higher. They go through cycles. They look good for a while, they break down, then they start to look good again, then they break down. It's just, not every chart has a beautiful move from the left lower corner to the right upper corner, where it just continually rises. Many of them do exactly what Diamond Offshore did here. A second chart, I'm going to give you a couple winners, and I'm going to give you a couple losers to show you the difference. Here, PetSmart had come out with great earnings, huge gap up, but look at that shooting star candle. That normally tells you're going to see some weakness, and saw weakness. Came all the way back down, and I think it was here. October 31st, bought at $34.82. So you got these other support levels in here, and $34.82 is the entry, sold at $38.96. So we're able to, and that was on November 15th. So, and it continued moving higher, and then again came back down. The point is, you got down to a level where you could keep a fairly tight stop with a lot of upside potential. And I don't even know why the sell here. John was pulling the trigger here. Maybe he didn't like that candle, or maybe it was maybe just because he's up 10% in 2 weeks. I'm not sure. But anyway, again, managing your risk to the downside, very important. NVIDIA. This one at Earnings Beats was bought on $9.25 right here. And I could see this one. Beautiful move up, very heavy volume, pulls all the way back down. And by the way, when it moved up, look at the RSI up in the 70s. When it pulls back down and hits gap support and price support, the RSI dips below 50. Now I can manage my risk. Maybe it's the 50-day moving average. Maybe it's gap support. Maybe it's the combination of both. But now I can be looking at a fairly tight stop with a return, or at least hoping that I'm going to get a return back up to 190. Earnings Beats actually triggered a sell on October 10th at 193. It was probably on this gap up. I'm guessing that they probably had a target of 190 and it gapped up above it, and they just got out. So again, NVIDIA went up, but then a couple weeks later, it was back into the 170s, 180s. So you're going to hold and just tie up your capital, or are you going to take these quick trades? Again, it comes down to individual preferences. Two stocks I want to show just on consolidation. These did not work out. And this is why I think it's important to have a stop in play. SCVL, it was bought on December 8th. Now, here was the gap up with earnings, huge move up, very, very overbought conditions. But check out December 8th right in here, coming back down near that 20-day moving average. And look at the RSI, which in this case was back down around 50 or in the 50s, much better than 85. But ended up getting stopped out on December 15th at 24.83. So this was a stock that was held a week, lost 20 cents on a $25 entry. So a 1% loser. And I'm looking at this trying to figure out, I'm guessing that maybe the stop was a close below the 20-day. It looks like it may have closed just below the 20-day on the 15th. Now, again, you might say with hindsight, well, you should have held, you could have gotten it back up 27. And obviously, if you knew that ahead of time, you would have done that. But who's to say you don't continue holding until it gets all the way back down to 21? Point is, I think what John had done here is he had figured out, okay, I'm going to hold it as long as it closes above the 20-day moving average. It didn't, and he took the loss. And then the last one, I know this one, I thought this was a perfect setup, and I owned it, and I know I ended up taking a loss on it. GII. Apparel group. And on this particular stock, here was the gap up. Look at this sideways consolidation for months. Beautiful gap up, great volume, looks perfect. Comes back down, and I remember that candle. Earnings beats got in on 921. I don't remember if I was in on 920 or 921, but basically it was at the same time. Pulled back, had the rising 20-day moving average, had gap support, price support. I mean, this was a thing of beauty, and I remember talking about it quite a bit here on the show. We got a nice move up, bounced off of it, but never got to the target, didn't take profits, and it came back down, and earnings beats ended up selling at 26.61, which was probably about a 5% loser. One of their biggest ones. I think that's why I picked this one. But it came down, and it was probably a stop below the moving average, a close below the moving average. And it probably closed. This was October 12th. So 10th, 11th. Must have been this one. I'm not sure where the stop was. But the point is, it didn't work out. It looked good. The setup was perfect, but it didn't look good. And if you had held, moved back up, hit the 20, and went down again all the way to $23. So you're able to get out of 26. Now, again, you might use hindsight and say, yeah, but you could have gotten out at 40. Well, I could make a lot of money if I could go in and just, look at what the stock did 4 months later and be able to trade off of that. That'd be perfect, but that's not reality. Reality is you have to make those decisions in real time, and they're not nearly as easy as looking back on a chart and seeing where everything ended up. So anyhow, for me, that's the difference. Breakouts, I think, can be solid trade candidates, but there are a lot of factors that go into it. Depending on if you're breaking out with a negative divergence, if you're breaking out with light volume, if you're breaking out, but you've been breaking out for the last 10 days in a row and you're very stretched. There's a lot. Just be careful with those breakouts. And if you miss a breakout, don't chase it, because a lot of times they'll come back to you and you'll be able to get back in at support. And then on the consolidation side, again, this is my favorite. I love to trade gaps like this gap. This was an earnings related gap on GII, and came all the way back down exactly where I wanted to get in. Had great reward to risk in mind on this one. Figured I could probably get about $3 to the upside, which would have been, I don't know, maybe 11, 12%. And to the downside, I don't remember where I got out of this. I may have gotten out on the candle where we broke down below the gap support, maybe a little bit lower. I'm not sure. But the point is, you can keep if you manage your stops, you manage your risk, you can create a trading environment where your gains tend to be much higher than your losses are to the downside. It's not about being right 90% of the time. As I said, earnings beats was right 36 times. and we were wrong 30 times in 2017. So get that out of your head that you have to be right every time. The key really is in managing risk.